You see that? For those that don't think it's a big call, look at that distance. That is in normal geometric scale. We've got this far so far, 25 to there. That's how far we've done. In case you don't think the calls we are making are ballsy, that's how much we still have to go to deliver our on-target performance. And then after a rest here, we see single digits, which will be a 4-digit number. Could be thousands, 2,500s. It could be crazy numbers.
Global markets remain caught between slowing growth, stubborn debt burdens, and rising distrust in paper assets. In that kind of environment, francishunt argues that volatility is not random noise, but part of a larger rotation already underway. He believes major moves often begin quietly, when sentiment is still divided, and most investors remain focused on yesterday's winners. That is why he continues to watch precious metals and broader risk markets through technical analysis rather than headlines. francishunt, a technical market analyst known for pattern recognition and macro timing, explains that both gold and silver may have already printed meaningful lows after a violent correction. He points to calming volatility, wedge breakouts, and basing formations that often precede stronger upside phases. His broader view is that gold may lead first, but silver could accelerate faster once confidence returns. If momentum confirms, he suggests silver could outperform dramatically in the next leg higher. Now, we present the clips from Francis's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
So, what's happening? A calming is happening. The volatility is reducing, which is absolutely perfect and a great thing to have happen. And a falling wedge has broken. And you can see it, and I'll be showing it to you. So here's something else that often can happen. When a falling wedge breaks, and let me just remove that Fibbo, it's quite a busy chart. What can also happen, so we expect 3 waves. This stems from Elliott wave of selling. You get the shock, slap in the face sell, which is the most brutal it appears to be out of the blue. It wasn't. And the next major video I'm going to be doing is on money management, psychology, how and why we were out and didn't get smashed by the sell-off. What I clearly just didn't see, the amount of people that were taking leverage longs late in this blow-off move. Each time I discuss this, more and more it's clear that there were a lot of bad hands getting in very late, long after we said it's shoot or scoot time. And how and why you should have been out, and the psychology and what keeps you in, and it's drugs. I'm going to tell you straight up, it's drugs. Your personally made drugs. The thrill of waking up and seeing green number go up, you don't want it to end. Even if someone whispered in your ear, it's going to end soon, you wouldn't do it. Some people wouldn't do it. That's why we have a community. That's why we train you that you have to end the party. You have to leave the party. All the girls are chatting to you and telling you how handsome you are. You're feeling like a stud, and you've got a lovely drink in your hand, and you're dancing, and you feel like you're John Travolta. And all of that is going down, and your mate's going, time to go, bud, time to go. You're like, leave me alone. I'm in my Fonzie space right here. You can go. I'm staying. And that's exactly what happens. That's exactly what happens there. We'll be talking more. You took the drugs. Your body gave you the drugs. We'll explain more on that when we get a chance to do that video. Don't forget to hit always on the bell, otherwise you'll not get it. So what's going on here, and what's this big mess that I'm drawing here? Well, it's a falling wedge that was drawn on the regular. I've looked at it both at regular and daily, because we're on a daily mode, and I want to just highlight that that's regular. So you have rallied. However, you often get 3 sells. So we still think there's a possibility. That doesn't mean it has to happen. It just could be a minority possibility. You get the 3 sells. That's your second sell. Your low is for sure, I think, already in. And we did trade this long at that point, and we did very well on what's actually quite a small move. From here to here on the break of the falling wedge. However, what can happen, and I put it in orange here, is that you squeeze price behavior into a falling wedge. But what's actually gone on here is you also start to get a little bit of a rounded bottom near the lows. And this, I don't think you're going to trade lower than this 61. And this is what we're illustrating. You start a round out. and also the capping descending grind line, which is typically a straight line, you also start to bend. So you get a little bit of a rounded bottom, a bending out, a banana bend to your falling wedge, and you walk out a little. You haven't had a ripper break like you typically associate with the break of the falling wedge. And that can be because you may still have one more down leg before you go really strongly to the upside. And that is a hypothesis we are saying, bear in mind. In terms of normal terms, you've broken the falling wedge. That's what occurred, and we took the longs there when that happened. And I do, in either way, think that the 61 final low is your final low. And I'll also highlight that relative to gold, and this ties into the silver demand aspects, relative to gold, your worst sell-off was silver. Silver almost dropped half. And we'll come back to that when we do the money management mindset, the blow-off, why we were out, why we'd reduced margin already quite a few times, all the different levels, what it means, why it's the hardest thing to do, because you're the popular guy in the party and you've got to get up and leave them wanting you more, not staying and living in the glow moment. Note that that was 36. So 47.5, almost 48%, and this is 37. The second sell-off was less. Now, funnily enough, in gold, it was the other way around. And whilst gold is far lower beta, it goes up slower, it goes down more stably, which is why we've said in the down parts, you want to ensure if you're holding one, you're holding the gold, but it's better 21%, 0.4, 24.3. The second wave of selling was harder on the gold, but the silver got smacked harder first up. So just wanted to highlight that slight differentiation there. And the broadening structure is less favorable that you have on gold, which is why actually once it starts to move, I think silver will be quicker to be the outperformer than last time. So gold needs to move first. So there's your broadening structure. There's our typical splitter. You're roughly on it now. Let's just get that in the middle. I'm a little higher there. Something like that. So you're churning a little bit over here. You've recovered immensely. Again, I will say your low is likely in for gold and silver. But when you're at the splitter and you know, a little bit of that could be a flag and you could break up, but it could also have a little bit of a comeback into the ground floor, the first floor before coming back up. And the break is only confirmed on the broadening structure when the capping descending grind line is touched again. And that's some way away. So gold isn't going to confirm. I think silver will confirm sooner and will go up.
Francis Hunt says one of the biggest mistakes investors make is holding on to euphoric trades too long. He compares market peaks to a party that feels too good to leave, even when warning signs are visible. In his view, discipline matters more than emotion. That is why he emphasizes risk management, reducing leverage, and recognizing when momentum has already exhausted itself. He notes that silver suffered a sharper initial sell-off than gold, which is typical of a higher beta asset. Gold tends to decline more steadily and recover in a more orderly fashion. But once trends reverse, silver often moves much faster. Hunt believes that if gold confirms a renewed uptrend, silver may quickly become the stronger performer. He also watches equity to gold ratios, suggesting that traditional stocks may be losing relative strength. That kind of shift can mark the early stages of capital rotation into hard assets. Let's get back to the interview.
So, the SPY divided by gold, we've chosen our neckline in and around 1505. In fact, I don't know why I bothered with the 05. I would probably go 1500. The only reason we went 1505 is that's 1501. It just missed touching 15 dead. So that's why that's 1505. So we've lifted the line a tiny bit. Marginally higher highs, last high, the same M head, a very small right shoulder. You spilt, but actually this one hasn't even returned to neckline. This is even worse state. The selling across the tops here is even worse state than the tech market. And you have not even moved to the neckline. That is armpit 1 and armpit 2. That is the shrink wrapped head. This is a complex head shoulder. Often this occurs, you can get two shouldering. like that. And you'll note where you get the more elaborate shouldering, you can see how this has fallen away a lot quicker because you had a bit of the exhaustion potentially taking part in the first part of this move. Is it a classic head and shoulder? No, it isn't. And I'm not going to tell you that it is. But you do get a micro shoulder there. And you've had another rally up there, so you get two small, very small moves. You need to view that on a lower time frame to see it. Look, the fat candle coming crashing down and getting support. These are volume candles we are showing you. So this was a big fat candle. Hey, guess when it was? Da-da-da-da-da-da. You guessed it, 2020 March, the big event. And that's what I like about technicals. It shows you what it is. So also bearish. How low does she go? How low does she go for us? Well, in my opinion, let's just go off the log scale. I'll also put it in regular scale. You can see how big the moves are. I think you can go very, very low on this. I think you could make this target and be lower than all before. And by the way, for those that think these things don't work, or a technical analysis is just wrong, or doing cross-market technical analysis is just wrong, you absolutely get head and shoulders. Whoops, we've gone into triangles now, arrows. Let's just get that back. You absolutely do get head and shoulders, and there's the right shoulder over there. And that was a neckline. That was first, and that was the full scaled shoulder. And that's roughly near your lows, You got a lot more churn and chop and sideways. You got a final capitulation, and then you were reversing. So this was a great time in and around the end of 2011 to get back long tech or equities generally. This isn't tech anymore. Sorry, we run the Standard & Poor's, not exclusively tech. But you don't want to be doing it during that phase. And what are we saying? We're saying we think you're going to run actually lower than the previous lows. So you are actually making lower highs. I see lower lows out of this. Lower lows. So your nominal number in dollars may be going up, but your dollar is in a debasement period. And the interest rates to get borrowing, the UK put out 15 billion, one of its largest auctions ever. So this is not just a beat up on America. The debt market as a whole, because all the lepers have copied each other, there is no whole true sound money nation that has said, hey, we're really not doing this proliferation. As I say, if you have to hold a fiat Swiss franc, probably the best. You might do okay on the Singaporean dollar, but no reason to hold it unless it's, unless you can't hold gold or you're needing money soon. And they're all in a debasement cycle, and the debts and the rates will be going higher. The UK, let's go find that tweet now. So I'm doing a bit of news today, a little bit of charts. It's kind of slightly different to what we've done. So we're done with our friend Lance. We don't agree with him. By the way, let's also go silver April month by purchases. So here's what's been happening. So silver's traded down, and I'm going to be doing a different video than usual. So a lot of delivery for April. Let's take out April. Silver, China silver purchases. That's the thing. I want to bring you a piece of news that some of you might missed. That's the one. China just imported more silver in March 2026 than in any month on record. 800,000 tons. Now, silver isn't gold, but that's some weight. 800,000 tons. That's 100% higher than previous years. There's the chart. So, not money that's going into silver is not going into treasuries. We can certainly say that. And they want to use solar. And they always give you the it's the solar guys that did it, that's the reason, that's all. Well, hang on a minute. If silver's broadly available, why do they all have to rush, overcommit buy to the tune of 800,000 tons now? It's because they either fear future unavailability, they see the current price after the sell-off as a buying opportunity to secure better margins for themselves as the profit motive. And there is far more genuine evidence of big profit motive in China than I see in a lot of other things. Or they're anticipating a very high level of future demand in terms of solar as a result, and energies per se, and want to ensure that they can cope with that future higher demand. So there's 3 reasons why they all surge bought and took the March number to a record high. Those are your reasons. Falling wedge is broken to the upside. We can take a little look at that chart for you. But, there's something going on there. And everyone will go, yeah, but, the fact that I heard some guy on saying the fact that it could be supply shows there's no shortage. No, if he's confident there's no shortage, he doesn't feel he has to have it in his very own yard already paid. People don't spend or pay the invoice before they have to. The just-in-time model is a capital efficiency model. You don't buy 800,000 tons to have it sit in a warehouse instead of earning interest in Chinese yuan, US dollars, whatever, if you don't feel that it's in your benefit. And the reason it's in your benefit is you have concerns about supply. You think that you think the price is about as low as it's going to get, and it's going to be more expensive in the future, etc., etc.
The deeper message from Francis Hunt is that markets move in cycles of emotion, leverage, fear, and repricing. When bubbles deflate, capital does not disappear. It simply searches for stronger foundations. If confidence in equities weakens while inflation pressures and debt concerns remain elevated, gold and silver could become natural destinations for defensive capital. He believes gold is a steadier signal asset. When gold breaks higher and holds gains, it often reflects growing concern about currency value, sovereign debt, or systemic risk. Silver then becomes the catch-up trade, benefiting from both monetary demand and speculative momentum. That is why Hunt sees the potential for silver to surprise investors once momentum fully returns. If his technical roadmap proves accurate, the next phase may begin slowly, with frustrating pullbacks and disbelief. But once resistance levels break, the move could become much faster than most expect. Investors who wait for headlines may arrive late, while those studying structure may already be positioned. His framework reminds viewers that timing, patience, and emotional control matter as much as asset selection. The coming months will reveal whether this is a rebound or the start of a larger precious metal cycle. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.